Hello and welcome to the monthly recap. This is for the month ending today, Wednesday, December 31st, 2025. You officially made it through another year. Congratulations. Like, we take it for granted, but it's not always so easy. So, congratulations on surviving a rather challenging year. I hope you all had a wonderful month. This was a rather busy month. Lots to get into, starting with the Fed cut rates by a quarter percent. That's great news. And then they struck a little bit of a dovish tone after the fact. So give me time about the hawks and the doves again, what exactly that means, and why the Fed's comments after the fact were rather dovish in nature. Um, Government shutdown came to an end, as you well know. Well, with that, when the government shut down, there was a lot of data that was no longer flowing to the markets. Inflation data, jobs data, all that kind of ground to a halt rather quickly. So that data has begun to flow to the markets. Lots of data to digest and get into. And then mortgage rates ended the month and I guess the year around 6.125%. That's for a first time home buyer making like 100, less than 120% of the area median income, kind of one of those ideal scenarios. But rates ended the year right around 6.125%. So lots to get into. Happy Kwanzaa, happy Hanukkah, Merry Christmas, Happy New Year. Lots to talk about. But yeah, I hope you all have a wonderful holiday season. And yeah, let's get right into it. So on December 10th, the Fed wrapped up their final meeting of the year. Okay. And not only was it the final meeting of the year, but it was one of the bigger meetings of the year as well. It's a meeting associated with a summary of economic projections, which means the Fed doesn't just make their Fed rate decision, but they actually have to show their work a little bit. Where do they think inflation is going to go from here? Where do they think GDP is going to go from here? What do they think about the labor market? What do they think about the Fed funds rate in the future as well? They have to show their work. And so it was one of the final meetings of the year, but it was also the biggest meeting, one of the bigger meetings of the year as well. And as I mentioned, we've got these hawks and these doves. Okay, so what is a hawk? A hawk is something that's fiscally restrictive. Okay, the Fed has this dual mandate of maintaining price control as well as maximizing employment. Okay, maintaining price control, maximizing employment. Well, they focus more on maintaining price control, basically keeping inflation under wraps, under control. That is a hawk's first and foremost concern. Doves, on the other hand, are more fiscally accommodating. So they're more in favor of rate cuts, and their focus is on the labor market, not inflation. Doves focus on the labor market, not inflation. Hawks focus on inflation, not the labor market. Hawks want to keep the Fed funds rate unchanged or even increase the Fed funds rate. Doves want to cut the Fed funds rate and be more fiscally accommodating. So it just depends. And you might have hawks that become slightly dovish in nature over time and vice versa. So it's not like you're either one or the other, black and white. No, there's definitely gradients and gray areas in the middle. But they've been fighting over this quite a bit. Do we cut rates? Doves. Do we leave rates unchanged? Hawks. They've been going back and forth. So at the Fed meeting rather, they had three dissenters. So a dissenter is anybody that disagrees with the final opinion. Okay. Well, dissenter is not necessarily a bad thing. It simply means that they disagree with the decision that was made. So we had three dissenters. It's rare to get even a single dissenter, let alone multiple dissenters. And this is multiple times that this has happened this year. So it's a little bit of a a little bit of a divided Fed that we're seeing right now. Three dissenters in the meeting. One member wanted 0.5% cut. Technically, that is a dissent because they did not agree to the 0.25% cut that was made. And then we had two members that wanted no cuts. They were definitely dissenters as well. Fed funds rate was inevitably cut 0.25%. That is now in a range of 3.5% to 3.75%. So that is the rate that lenders exchange money with each other at. Okay. And because of that, it directly impacts short-term rates. It's literally the shortest term rate, like overnight rates. So short-term rates. So car loans, personal loans, credit cards, home equity lines of credit, your savings account. All of those are short-term rates and are going to be directly impacted by that Fed rate cut. That means that we got 0.75% in cuts in 2025, so 0.75% in cuts in 2025. If we were to rewind a year ago, the projection at that time was for two rate cuts in 2025. So we actually got one more than was originally predicted a year ago. Now the majority opinion for next year is between one and two rate cuts. I'll tell you why I think there's reason to believe that it's going to be closer to two instead of one, and honestly, it could even be more than that. These projections change rather quickly. Now, the Fed, they seemed rather optimistic about the economy as a whole. And that is one of the big takeaways from the notes from that meeting. Okay, and by that I mean the Fed is now expecting GDP to be between 2.2% and 2.5% in 2026. Well, back in September, when they last had this meeting of summary economic projections, that was they were only predicting between 1.6 and 1.8%. So they are feeling rather optimistic about the economy in 2026. And the good news keeps coming from there. The Fed is expecting unemployment around 4.5% by the end of 2026. Why is that optimistic? Well, that's really optimistic because right now, today, it's 4.6%. So they're expecting that to decrease. I'm honestly a little bit perplexed by that, personally, because it's been a pretty straight line. Since June, unemployment has only gone up and up and up and up and up some more. And it's literally every single month that we're seeing that rate increase. So I think it's going to get worse before it gets better. Does it fall all the way back down to 4.5% by the end of 2026? Maybe, but that's pretty optimistic. The Fed is feeling pretty optimistic as a whole. Fed is also feeling optimistic on inflation. They decreased their inflation projections from 2.6 to 2.7% down to 2.4 to 2.5%. Again, very optimistic. They're expecting us to get really close to the Fed's ultimate target of 2% inflation. They are also acknowledging that it's probably not going to be until 2027 when we see that. But still, pretty optimistic with regards to inflation as well. All right. So I mentioned that the Fed struck a little bit of a dovish tone after the meeting. And here's exactly what I'm referring to. So Jerome Powell went out of his way after the meeting wrapped up to mention that he feels that the Bureau of Labor Statistics, BLS, is overstating job growth by 60,000 jobs per month. He went out of his way to say that. He was not prompted to say that. He was not asked a question about it. He literally went out of his way to say that, which is pretty important to note. He does not do that accidentally. I've joked before that I felt like BLS report should really change their name to BS report because their numbers have been unreliable. Jerome Powell agrees. Okay. He's expecting that if we took the tariff impact out of inflation, that inflation would likely be in the low twos already, very close to the Fed's ultimate target of 2%. That's a very dovish comment to make. Here's somebody that's saying that he does not think inflation is as bad as the numbers show, and he's thinking that the labor market is weaker than the numbers show. That is a very dovish comment because, again, the doves care more about employment, less about inflation when it comes to making these decisions. In addition to all of that, the Fed's going to get more dovish in 2026. We're going to be getting a new Fed president. Jerome Powell is going to be on his way out. Fed chair is technically the term, sorry. Fed chair, not Fed president. And there's going to be 4 new members rotating in. Every year, 4 members rotate in, 4 members rotate out. And the 4 that are rotating out, 3 of them are very hawkish, again, fiscally restrictive, less likely to cut rates. And 1 of them was pretty centrist. So we're likely going to see a more dovish Fed come 2026. That may mean that we see 2 rate cuts. It may mean that we see more than that as well. Again, more doves, more likely we are going to see Fed rate cuts. With regards to the Fed meeting schedule for next year, here's what it looks like. Again, the meetings in bold are the 4 biggest meetings of the year. So those are March 18th, June 17th, September 16th, December 9th. I doubt we'll see a Fed rate cut on January 28th. That would be a big surprise. But it's entirely possible that by March 18th, we start to hear more rumblings and talk about a possible Fed rate cut. So here's the Fed schedule. Definitely be keeping an eye on that as we go forward. As I mentioned, with the government shutdown coming to an end, we started to receive a backlog of data. And some of that data was on inflation, okay? And the doves, here they are, having a little dance party, having a good day, because inflation is cooling, okay? That's the big takeaway. So we got both October and November consumer price index, which is the Fed's second favorite measure of inflation. That came in up 0.2% for both those months together, which means 0.1% per month. That's very cool. That means the yearly headline, which is all in inflation, came in at 2.7%. That's down from 3%. That's a significant move downwards. And we saw a similar, even better move downwards when we look at the core rate, which is when you remove volatile food and energy from that equation. Again, came in up 0.1% each month, which, again, if we got that 12 months in a row, we're looking at 1.2% inflation. That'd be huge. So good news here. Again, yearly came in at 2.6%, down from 3%. Again, significant improvement on inflation. That's really, really good news. And when you look at the numbers that are going to be replaced in the spring, uh, those numbers were really, really hot. So we're going to make some very meaningful progress on inflation in the spring this year, 2026 rather. Personal consumption expenditures, that's the Fed's favorite measure of inflation. Headline, all in again. That came in up 2.8%. That's actually up from 2.7%. Now, that's with gasoline prices. And when they looked at these numbers, gasoline had a large impact on these figures. When you remove volatile food and energy from the equation, the core rate actually went to 2.8%, down from 2.9%. So again, taking a step in the right direction, inflation is cooling, which is great news. So inflation is cooling. Good news. And if you look at the labor market, it looks like a very weak labor market. And here's the, again, backlog of data that we received when it comes to jobs reports. So job openings and labor turnover survey, this one was a little bit of a head scratcher. The job openings increased from 7.23 million to 7.67 million, which is, again, a little bit of a mind-boggling figure because the hiring rate, companies actually hiring people, is at 3.2%, the lowest level since 2011 when you exclude COVID. So yes, employers have job openings, but they're not filling them. They're not hiring them. It's kind of, again, perplexing, like I said, a little bit head scratching. Like, how can you have so many job openings, but the jobs are not getting filled? You have as many job openings as you want. If you're not filling the seats, it doesn't really freaking matter, right? So it's a little bit of again, perplexing figure. Layoffs did hit the highest level since January 2023. Quits rate, those who are quitting their jobs, that fell from 1.9% to 1.8%. That's the lowest level since 2014 when you remove COVID. Again, that points to a very weak labor market. Employees feel confident in quitting their job if they feel like their prospects out there are really, strong. Well, yeah, when we see people quitting their rates at a very low rate, it does not point to a strong labor market. It actually points to a very weak labor market. Bureau of Labor Statistics, like I said, they did have 64,000 job gains in November. That's a very good number. It slightly beat expectations, but they had 105,000 job losses in October. So who cares about this one good number in November? The number from the month prior was just abysmal, 105,000 job losses. In addition, they revised the September report down by an extra 33,000. The unemployment rate now, again, like I said, is at 4.6%. That's up from 4.4% the prior report we got. So again, just weak labor market is being shown all over the map. ADP, which reports on private sector jobs, 32,000 job losses in November, 42,000 job gains in October. But yeah, again, kind of pretty anemic numbers, not very strong at all. So yeah, when you look at inflation cooling, yay, and you look at a weak labor market, again, it gives a lot of sway, a lot of strength to the doves. They are worried about the labor market. They're not worried about inflation. They want to cut rates more aggressively. And we also see this turnover within the Fed, 4 members leaving, 4 members being added, and 3 of those 4 members that are leaving are, hawks. It should be a more dovish Fed. And I can almost guarantee you that whoever the next Fed chair is, even though we don't know it yet, that next Fed chair is likely going to be more dovish in nature as well. So, yeah, I think there's cause for optimism with regards to Fed rate cuts in 2026. I think it's going to be, personally, if I had to guess, I'd say at least 2. It wouldn't surprise me at all if we got a third one in there as well. All right. So looking ahead, Happy New Year. Enjoy the new year. We're going to be back to a normal data release schedule. Thank all that is holy. This whole whiplash of, no data and then all the data at once is a little bit, anyways, back to normal data release schedule. Great news there. Like I said, we'll be able to start making some meaningful progress on inflation in the spring because we're replacing some very warm numbers in 2025 that we had in the spring. Those are going to be wiped out by hopefully cooler numbers, and we should see some pretty meaningful progress being made on inflation. How persistent is the softness in the labor market? The Fed's very optimistic there. I'm a little surprised how optimistic they are, considering what we've seen the last 6 months. But they are very optimistic in the labor market as well. They think that this is just a blip on the radar and it's going to go away soon enough. And then what type of economy does the holiday spending reflect? We'll start to receive all those numbers from all the various different businesses. It was a very busy Black Friday, Cyber Monday. Like, great. Was that it? Or do we still have a little bit more to tell? It's going to be very interesting to see, what kind of economy the holiday spending reflects. I think that's it. I hope you all have a wonderful new year. Be well, be safe, be healthy. As you can tell, I'm fighting a little bit of something myself. And I will see you in 2026. Thank you all. Bye.